We all love a good hero story. In the world of money, that story usually features a financial wizard, a gunslinger, who can see around corners, pick the next Apple or Tesla, and perfectly time the market to save you from a crash. It's a very seductive promise. We want it to be true because it would make our lives so much easier. But today, we're going to do something that isn't always comfortable. We're going to look at the official scorecard. We're going to ignore the marketing and follow the hard data from the last 20 years. Is it actually possible for these pros to beat the market consistently? Or are you chasing a ghost? We're going to find out if you're better off trying to find the needle in the haystack, or if you should just buy the whole haystack. Let's head to the video and check the score.
All right, let's dig into one of the biggest questions in all of finance, one that every single investor has to ask themselves. Is it really possible to beat the market, to outsmart everyone else, or are you actually better off just grabbing a hold of the market and riding the wave? We're going to follow the data on this one and see exactly where it takes us.
So, let's start with the promise, because it's a really appealing one, isn't it? We've all seen the commercials, we've all heard the stories, this idea of some brilliant, genius fund manager. A financial wizard who can just expertly navigate the chaos of the markets, sidestep the big crashes, and pluck out those winning stocks that nobody else sees. It's a powerful, powerful story.
And that really leads us to the core question, the one at the heart of this whole debate. Can they actually do it? I mean, not just have one lucky year, but do it consistently, year after year over the long haul. Is it real skill, or is it just luck? You see, this whole thing boils down to two totally different ways of thinking about investing. On one side, you've got active investing. That's the gunslinger approach. The goal here is to be smarter than everyone else and beat the market average. On the other side, you have passive investing. The goal here isn't to beat the market, it's to be the market. You just buy everything and match its return. So how in the world do we find out which approach is better? We can't just rely on marketing brochures or some guy on TV yelling about his hot stock picks. No. We need to go to the official scorecard. We need hard, unbiased data that's been tracked for decades. And luckily for us, we don't have to go digging for it. There are two major respected firms, S&P Dow Jones and Morningstar, that basically act as the official scorekeepers in this big game. Their reports are pretty much the gold standard for settling this exact debate. And the way they do it is what makes all the difference.
And here's why these reports are so powerful. First, they track pretty much every fund out there, so the data set is huge. Second, they make sure they're making fair apples-to-apples comparisons. But here's the real secret weapon. They account for something called survivorship bias. Think about it. What happens to funds that do terribly? They get shut down. They disappear. These reports don't let them off the hook. They include the dead funds in their analysis, so we get a true, unfiltered picture of how managers actually performed, winners and losers.
Now, in any given year, sure, it can be a bit of a toss-up. Some active managers get lucky. But the real story, the one that actually matters for your money over your lifetime, that's only revealed when you look at the long-term data. So what does the official scorecard say?
Okay, get ready. Here's the first jaw-dropper. Over the last 15 years, and think about that period, it had huge booms and catastrophic busts. A staggering 84% of active U.S. stock funds failed to beat their simple benchmark index. Just let that sink in for a second. That means your odds of randomly picking a winning fund were about 1 in 6.
But wait, it actually gets worse. When the analysts dug deeper and adjusted the returns for how much risk these funds were taking on, the number of underperformers shot up to an incredible 95%. That kind of suggests that the very few who did manage to win probably weren't smarter, they just got lucky by taking on way more risk.
And if we just zoom in on the most popular category, funds that buy big U.S. companies like Apple and Microsoft, the number becomes almost hard to believe. Over that same 15-year period, 97% of those active fund managers failed to beat the plain vanilla S&P 500 index. 97%.
Okay, but I know what you're thinking. This is the big counterargument, right? People will say, sure, maybe they lag when the market's going straight up, but the real value of an active manager is to protect your money during a crash. This is their time to shine, right? They can sell stocks and go to cash to save you. Well, let's check the scorecard on that one, too.
So this table shows what happened during 3 massive market downturns. And look at the pattern here. In 2001, the market fell 12%. More than half of active funds still underperformed. In 2002, the market's down 22%. Same story. And even during the global financial crisis of 2008, when the market got crushed by 37%, nearly 2/3 of active managers still failed to do better than the index. The data here is just crystal clear. that promise of downside protection, it's largely a myth.
All right, so the next logical question is, okay, most of them fail, I get it, but can't I just be smart about it and pick one of the few winners ahead of time? Can't I find that golden needle in the haystack?
Well, the first problem you're going to run into is that the haystack itself is constantly shrinking and catching on fire. Over a 20-year span, almost 2/3 of all stock funds either get shut down or emerged out of existence. And why does that happen? Well, it's usually because their performance was so bad. So the majority of funds you could pick from today literally won't even be around in 2 decades.
And this quote from Just ETFs really just nails it. Yeah, it's true. A tiny, tiny fraction of managers will have staying power. They will succeed. But finding them beforehand, well, as the data shows, that seems to have a whole lot less to do with skill and a whole lot more to do with pure, dumb luck.
And we have the data to prove that point too. So imagine you did all your homework. You found a fund that was a top performer, in the top 25% of all of its peers. You'd feel like a genius, right? Well, studies show that just 4 years later, only 4% of those winning funds were still in that top tier. It turns out that past performance is an absolutely terrible predictor of future success. So what on earth does all of this mean for us as regular investors? It really begs the question, why is this so incredibly difficult? Why can't all these brilliant, highly paid pros on Wall Street consistently beat a simple computer-run index fund? Well, the evidence shows it really boils down to 2 huge, almost impossible hurdles. The first one is higher fees. Active funds just cost a lot more, and that creates a guaranteed headwind, a drag on your returns every single year. The second is just how hard it is to predict the future. The data shows that trying to consistently pick winning stocks and perfectly time the market, well, that's a game that even the best in the world can't seem to win consistently.
And you might think, oh, 1% in fees? What's the big deal? But don't dismiss that. As the financial educator Paul Merriman points out, a gap of just 1% in your annual return, year after year, caused by those fees and that underperformance, it compounds into a massive, life-changing difference over an investing career. We're talking potentially millions of dollars.
So, when you put all of this data together, the ultimate takeaway is pretty stark. It seems the smartest move isn't to take on the nearly impossible luck-based challenge of finding that one magic needle. Instead, the evidence all points in one direction. You're probably way better off just buying the entire haystack with a simple, very low-cost index fund.
Which, of course, leaves us with one last, absolutely fascinating question to chew on. If the scorecards are this lopsided, if the evidence is this overwhelming, then why do investors still pour trillions of dollars into active management every single year? Now that is a puzzle for another day.
It's a bit of a shock to the system, isn't it? To realise that 97% of the smartest, most highly paid people on Wall Street actually fail to do what a simple, low-cost computer program can do. The data tells us that the gunslinger approach isn't just difficult, it's nearly impossible to get right over the long haul. But here's the good news. You can stop trying to win a game that even the pros are losing. When you choose to be the market instead of trying to beat the market, you stop paying for luck and you start capturing the actual growth of the global economy. You trade high fees and constant anxiety for a strategy that is proven to work. So I'll leave you with that puzzle we mentioned at the end. If the evidence is overwhelming, why do people still keep trying to find the one magic needle? Maybe it's because we all want to believe we're the exception, but your retirement is too important to bet on luck. If you want to see how much your active fees might be costing you over time, or if you're ready to simplify your strategy, let's talk. Subscribe to keep following the data with me, and I'll see you in the next video.